3 straight sessions. The S&P 500 has been bleeding for 3 consecutive sessions as Treasury yields explode to multi-month highs. This just happened, and most investors don't realize what it means yet. Here's what's really going on, and what you should be thinking about right now. The bond market is sending a warning shot. Treasury yields are surging right now, and they're dragging equities down with them. This isn't random volatility. This is the bond vigilantes flexing their muscle. Who are the bond vigilantes? They're the institutional players, massive fixed income funds, who sell treasuries to punish governments for reckless fiscal spending. When they sell, yields spike. When yields spike, everything else cracks. And now, legendary analyst Ed Yardeni, one of the most respected voices on Wall Street, is sounding the alarm. He's warning the Fed may be forced to hike rates in July. Not cut, hike. A Reuters poll confirms it. The Fed is unlikely to cut rates at all in 2026. Let that sink in. The rate cuts the market has been pricing in? They may never come. Growth stocks are the most exposed. Higher yields mean future earnings get discounted harder. The Nasdaq felt that pain. 3 sessions in a row. And if you're holding long-duration bonds thinking they're safe, rising yields move inversely to bond prices. Your fixed income allocation is not a safe harbor right now. But here's what nobody is saying about this yet. The real story isn't the Fed. The Fed is the symptom. The bond vigilantes are responding to runaway fiscal deficits. And no politician in Washington is blinking. If spending stays unchecked, yields could push even higher regardless of what the Fed does. This isn't a short-term spike. This could be a structural reset in the cost of money. And most retail investors are completely unprepared for that world. First, audit your duration risk today. Long-duration bonds and rate-sensitive rights are in the crosshairs. Know your exposure before yields move again. Second, reassess your growth stock concentration. If a July rate hike materializes, high multiple tech names get hit hardest. Valuations compress fast when the discount rate rises. Third, short-duration instruments deserve a second look. Treasury bills and money market funds are yielding real returns right now. That's optionality while you wait for clarity. The bond market just called the Fed's bluff. A potential July rate hike. No cuts through 2026. Bond vigilantes in control. What does this mean for your portfolio? Drop it below. I read every single comment. This video is for educational purposes only. Not financial advice. Always consult a qualified advisor before making any investment decisions.